Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we're talking about a post that struck a chord with many investors. A Reddit user, he wrote, "Feeling cheated by the market, 7 years of SIP and I'm done." He goes on to say that he'd invested about 11 lakh rupees through SIPs over a period of 7 years, and today the value is 16 lakh, and that is disappointing to him. So is SIP failing investors, or are investors failing to understand how SIPs work? We'll talk about it in detail with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So to begin with, this investor feels cheated because 11 lakh rupees SIP is now worth 16 lakh. That's about 7-8% CAGR. Is that poor performance?
One has to look at it from multiple angles. One is that he has been able to keep aside 11 lakh, which he did not have. It's going to be about 1 year. Since the market has been drifting, it came down, went up. Some people might be disappointed because large number of investors have started their SIP in last 1 year, 1.5 years. Somebody invested gradually 11 lakh rupees or been able to accumulate his savings gradually into mutual fund, 11 lakh rupees over the last 7 years. So 11 lakh rupees did not go to work at 11 years ago. You started with 10,000 rupees. Then you increased it. You kept investing. Your own contribution has been gradually. So your oldest money, 7-year-old investment is 10,000 rupees. The next month, there onward, it is another 10,000 rupees, then another 10,000 rupees. You have to look at it like that. You have been able to accumulate. And this might be disappointing. Maybe he has chosen the worst of fund. I looked at the data and I looked at the SIP return of all funds over the past 1 year, 3 years, 5 years, 7 years. And what I find is that last 1 year has been disappointing. It is in the but it's not negative. It is still in the vicinity of, in the range of 8 to 10%. Most of them are converging there. But when I look at the median SIP return of all equity fund in all categories, the only place where somebody is struggling is the technology fund. Everywhere else you are beating inflation. And when you go to a period of 3 years and more, 3 year, 5 year, 7 year, everybody is beating the fixed income return and inflation, beating the fixed income by twice as much. I'll be very happy with somebody generating 13-14% return. I would urge him to set up his portfolio on Value Research Online. Based on your periodic investment on the specific date, you will get the real precise return, as if you are doing some investment. You're doing a recurring deposit. How much return you get, and that is the real benchmark. If you are still at it, there is another way of looking at it. If you need the money after 5 years, 10 years, I would like the market to remain subdued all through and go up little before when I need it. And that is when it will be very rewarding. That is the way you actually buy low and sell high. Markets will be like this only. If you are thinking that market is going to become a 22% or 20% or 18% yielding fixed deposit, no, it's not one. It's reason to be very happy because this is not the worst of it. Be prepared for some calamity as well. What happened in 2008 when you see all this money, assuming that his 11 lakh became 16 lakh, but if it would have been 2008, this 11 lakh becoming 16 lakh and goes down to 8 lakh rupees from the peak. That is disheartening. That is heartbreaking for many people. That is, destructive. That is when a lot of people lose faith. So I would say that keep the faith. It's an act of faith. You are in a diversified portfolio. Choose a reasonably good fund. If not, and be at it. And just think of the alternative. If you are able to beat fixed income return, feel happy about it. Everything else, I think the bonus comes when you least expect it.
Okay. Now, the Reddit post also said that if he had bought a land instead, he would have probably doubled or tripled his money. So is real estate really that much better?
No, with real estate, the point is that he would not have been doing SIP.
Right.
He would have needed a large sum of money. And, God forbid, if you got stuck with something like the JP property or this property or that property where builder took the money and actually never got his people to start building it. So it's a high ticket size. One has to look at it that it's an accumulation vehicle. Accumulation vehicle, feel happy that it is not doing well. You are able to buy cheap. And to be able to accumulate this, Where do you get a piece of land in 11 lakh rupees? I think by all means somebody should have a framework of buying a house to live in it. When you think of real estate, you think of 10 years, 20 years, 25 years. And that is when you get all these beautiful stories that my grandfather bought this land and now it is 100 times. But nobody tells you that I bought this index fund or I bought this share and I held it for those 30 years, 25 years. And that is when here magic happens in small sachet. That's a big thing.
Right.
So by all means, consider property, but you should have that capital. Otherwise, for most ordinary Indians, trying to accumulate a meaningful capital with small contribution, this is the most promising thing.
Right. So for someone who is new to investing, how would you describe an SIP to him so that he understands what it is and how to build a large corpus with SIPs?
No, one is that I would like to tell him that you will not build a large corpus. The corpus will get large over many years only if you be at it.
Yeah.
Because large corpus gets built even with a recurring deposit, which does not yield very high return. The promise of equity is that it will be able to beat fixed income. The promise of equity is that it will be able to beat inflation. And over and above that, you will have the cyclicality of the market, which will get reflected. And that is what, disappointing people. This is something where it is not going to do well all the time. And if, in fact, it starts giving you 20% return every year for 2-3 years, worry about it. Because it's too good to be true to be sustained unless companies are able to grow their earnings.
Right.
That is the nature of the free economy. If a company is able to generate high return on net worth and looks untrue, it will, competition will follow. Somebody will come. We don't see a single segment of the business where somebody is making a lot of money and competition doesn't follow. And that is what drives efficiency, that is what drives profitability, and that is what drives great businesses to build some competitive advantage so that they are able to retain those. They continue to do it and then they get destroyed or then they get distracted. Or there could be obsolescence, there could be technological change. So everything happens and you are buying that. So it will have the uncertainty. This is the only promise for individual investors, small guys, to create a meaningful capital with your small sum of money, building something at your convenience, at your pace, with great regulation. And so don't get put off by any of these. The real problem is short-term expectation. If you think that your 11 lakh rupees built gradually over a period of time has become 16 lakh rupees and you are disappointed, unless you calculate the real return. I don't know whether he invested most of the money in the last couple of years. And initially he did not invest much money. If he started with 5,000 rupee and now he started doing 25,000 rupee. Because this is a more realistic situation. Because when I look at the real numbers based on value research database, the median return for all equity category is in the vicinity of 14 to 19%. 14 to 19% is a very attractive return. And I'm talking of 3-year SIP. This is absolutely outstanding. Last 1 year, it has been disappointing, but it's still not disappointing at all, going that, it's still beating fixed income.
All right, now finally, what is the big lesson here for investors who are feeling frustrated by slow SIP returns?
One is that a lot of expectation has been raised. So moderate your expectation. Keep your benchmark that you should be able to beat inflation at all times, at least on an annual basis, which I think he would have done. Second is that, you should be able to beat fixed income return, because that is something where you in India, you still get a handsome return without taking any chance, any market exposure, any risk. And the state bank SBI deposits or the small savings schemes, they are, they are available around the corner. In every neighborhood, you can get started. Third is that, important thing which comes to my mind is that one should correct it accurately. Otherwise, you are getting disappointed for no reason. 11 lakh rupees becoming 16 lakh rupee over last 7 years paints a different story. But your 11 lakh rupee is not at work for the whole 7 years. You started with 10,000. Only a year ago, maybe, you had some 10 lakh rupees, which has been there for last 1 year. And I think, one needs to calculate the return very well to have your expectations in in control, well managed, because based on these impressions, based on the perception, based on the belief that you have not earned, and you create an echo chamber in yourself that you're not doing well, and you have been deprived, somebody has not delivered. Just see what the accurate return is and set up your portfolio on value research online. It will be able to assimilate all the investments at one go and give you a round number, and that will help you gain clarity.
All right, so there you have it. SIPs don't cheat, but expectations do. So moderate your expectations, but be at it and take a closer look at how these investments have grown over the years, how much did you invest when, and then you'll get a fairer picture. Now, moving on to the viewer's question for this week. So K. Nayak has written to us and he says, when we talk about SIP today, it means subscribing to a particular fund. Suppose that is not a constraint and you are at liberty to choose any fund or ETF every month. How should one take the decision about where to invest next installment?
I've been running value research for the last 35 years. I have not been able to learn how to choose a fund month after month. Maybe I'm old-fashioned. I like a fund and I like a fund for a reason, not for its returns only. Over a period of time, returns follow. And that is true for companies, that is true for funds, that is true even for debt fund. Because when I look at a debt fund, I don't look at that this is the best performing debt fund. Let me go for it. I'm not in the business of chasing performance. I'm in the business of understanding the process that what did this fund do that has translated into this return. And if I'm unable to decode the process, I cannot really trust that fund, because will it be able to replicate it? Right. Only when you understand that how this has been achieved is that you are able to develop a belief that yes, this is a replicable thing. If they keep doing it, this is the right way of doing it. So whenever we get a mysterious reason, when we get a great performance and we try and find out what is driving it, and then when we look for it and if we are unable to decode it, it remains a mystery. We let it pass. And we have never been disappointing by giving those passes, ignoring the funds which did very well, but we could not understand why it did well. And in any case where we understand that why it is doing well, and it is for a reason, whether it be great stock selection, whether it is thought process, and of course, in mutual fund, given the regulatory overlay, that one stock cannot exceed more than 10%. There is a certain, due diligence being exercised, the kind of, skin in the business enforced, and most fund managers and the fund company executive, they are now being forced to invest in their own funds. All these things, they are great alignment. And also, there are practical issues here. One is that if you keep investing in a new fund every month, or assuming every 3 months, in 5 years' time, you will have 20 funds. Assuming there is no repeat, every 3 months you are able to find the star fund. If you are going to, and then there is another problem. If you are able to find a good fund, will you move your money that you have already invested into this fund, which means redeeming and this? There is a fallout of that. If you do this, then it will be reduced by the short-term capital gains. It will be deducted from your gains, and then you will have less money to invest. So I would say that I'm still old-fashioned. Look for the process. Look for the reasons why something is doing well. And despite those reasons, markets will give you surprises. It will not do well all the time. And stay put. Just check that, the reason why you invested, is it all there? And that is what value research does.
Thank you, Dhirendra, for answering these questions.
Thank you.
Thank you for watching Investors Hangout. Keep watching the space for more information and do keep sending in your questions. We'll answer the ones that matter to most investors. Thank you for watching. Bye for now.